we have talked about the principle for revenue recognition. And to apply the principle, there are 5 steps. The first step is to identify the contract. The second step is to identify the performance obligation. The third step, determine the transaction price. The fourth one is to allocate the transaction price. And the fifth one is to recognize revenue when each performance obligation is satisfied. So we're going to come back to this definition in 1 minute. But before that, let's define some key terms here. So first of all, the first step is to identify the contract. Then what is a contract? A contract is an agreement between 2 or more parties that creates enforceable rights and all obligations. So that is an agreement between 2 or more parties that creates rights and obligations. And then the second step is to identify the performance obligation. Then what is performance obligation? Performance obligation, it is a promise to provide a product or service to customer. So in other words, performance obligation, that is an obligation to perform. That is a promise to provide a product or service to a customer. And then also in the fourth step, we need to allocate the transaction price. So what is transaction price? Transaction price is the amount of consideration that a company expects to receive from a customer in exchange for transferring a good or service. So that is the amount of consideration that a company expects to receive. So let's go back to this definition. The 5 steps for revenue recognition, that is actually, let me give you an example. So the first step, identify the contract. So for example, if I go in Starbucks in the morning, and then I said that I want a cup of mocha. So, and then a verbal contract is created here. So in this contract, I am the buyer, and then Starbucks is the seller. And then I have the obligation to pay. So once we have this verbal agreement, they're going to go to make the coffee, right? And then for me, for in this contract, me as a buyer, I have the obligation to pay, and I have the right to receive the cup of coffee. And Starbucks as the seller, they have the right to receive the payment, and they have the obligation to give me the cup of coffee. So this is basically a contract that is created. And then the second step, identify the performance obligation. So performance obligation, in other words, is the obligation to perform. So the performance obligation here is just for Starbucks to make and deliver to me the cup of coffee. And determine the transaction price. So for example, the coffee is $5. So the transaction price will be $5. So, and then in this situation, because this is, we only have 1 performance obligation, which is Starbucks give me a cup of coffee. So that is the case of a single performance obligation case. And then allocate the transaction price. So allocate the transaction price, it is not needed if there's only 1 performance obligation, but we do need to allocate it if we have multiple performance obligations at the same time, meaning that the buyer is, the seller should perform multiple obligations at the same, they have multiple obligations at the same time. We're going to talk more about it shortly. And then the 5th step, recognize revenue when each performance obligation is satisfied. So in this case, we only have 1 performance obligation, and it is the coffee will be delivered to me at a point in time. So it will be satisfied at a point in time. And then, so this is actually this situation. And then, which means that Starbucks, they can recognize revenue when they deliver to me the cup of coffee, which means that they can recognize revenue when their performance obligation is satisfied. So this is a simple example. And then we're going to look at 3 specific situations. So as you can see here that we have, in the end, we're going to have 3 situations. one performance obligation to deliver a good or service at a single point in time. So it is this one. And then the second situation is one performance obligation to deliver goods or service over a period of time. So it is this one. And then the third situation is multiple performance obligations. So which means that it is this one. So those are the three situations. And then we're going to talk about each of the three situations in detail.